Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, December 20th. You are tuned into On Trend, the show designed to keep you on the right side of the trend. So today we're going to look forward and see what it would take to turn breadth indicators bullish, to get a volatility spike, to see Treasuries reverse a big downtrend, and benchmark levels to watch going forward, as well as some pockets of strength showing up right now. We'll start with the breadth indicators that turned bearish in mid-October and show you what it would take to trigger bullish signals. All right, so the first indicator is based on AD%, and that is advances less declines divided by total issues. And I've got it for four indexes: the S&P 500, the S&P Mid-Cap 400, and the S&P Small-Cap 600. Now, those are my three core indicator groups, so to speak, my three indices. All right, I threw in the NASDAQ 100 as well, just to show you that it can be added to this group. Now, basically what I'm looking for is a surge in AD% on the upside to show a breadth thrust, a surge to the downside, a plunge to the downside to show a bearish breadth thrust. So looking at the daily readings here, you can see that, in late November, we had some surges above 70% in the daily readings, but then boom, we got that first surge below minus 70% in early December, and that started the recent decline that we had with that bearish breadth thrust. And if you scroll down, you can see for the indicators for the S&P 600 and the NASDAQ 100. All right, but what I'm looking at here is the 10-day EMA of these indicators, because it doesn't trigger signals as often, and I think it can be used as a medium to long-term indicator. I mean, my long-term goes out maybe 3 months, and I'm not going to look out like 6 months or a year, and I'm not going to give a 2019 forecast because things will change in March probably, or April, I don't know. But, a one-year forecast is really hard to do, so to speak. But if we look at the 10-day EMA, it gets a breadth thrust when that EMA moves above plus 30%. All right, and I'll go ahead and move down to focus on the S&P 500, S&P Mid-Cap 400, and S&P Small-Cap 600. So we can see that in March, two of the three had a breadth thrust above plus 30%. And so that triggered a bullish breadth signal for that indicator because two of the three were bullish. And the S&P fell short back in March, 29.3, but it triggered there in late June. And they remained on bullish signals until February, when all three triggered bearish. All right. And then we got one lone bullish signal in the S&P 500, but that wasn't enough in November. You need two of the three to trigger. And we got bearish affirmations this week with the moves below minus 30%. So all three of these indicators are on bearish signals. They've been bearish since February, actually, net bearish. And they need to move, two of the three need to move above those 30% thresholds to start thinking bullish again. Now in the bottom window, I've got the NASDAQ 100. And you can see it had these two bearish breadth thrusts. In between, there was one bullish breadth thrust. But look at that. Didn't get above plus 30% after that bearish thrust in March. And then we got three more bearish thrusts over the last 3 months. So this indicator is net bearish for the NASDAQ 100. Now, the next indicator group is based on new highs and new lows. And so first I'm showing you new highs and new lows separately, and you can chart those individually at stock charts. You can see I've got exclamation point, new low SPX for new lows, exclamation point, new high SPX for new highs in the S&P 500. And if you scroll down to the bottom, which I'm doing now, you can see how I charted that. I used price up-down pair as the indicator, and then for the parameters, I put those two signals separated, two symbols separated by a comma, and then I added some horizontal lines for good measure. And so I charted these for the S&P 500, S&P Mid-Cap 400, S&P Small-Cap 600, and NASDAQ 100. So the key levels for this indicator would be 10%. And so now I'm going to move over to the high-low percent indicators, because high-low percent is basically new lows, or new highs actually, minus new lows divided by total issues. And so you can see when that gets to minus 50 or lower, you get a move below 10%. And I'll show you that on the next chart. So here are the high-low percent indicators where they've already subtracted new highs minus new lows divided by total issues. And you can see that we had bullish signals there in March for the S&P 500 and for the S&P Mid-Cap 400. And if I scroll down below, you can see we got one for the S&P Small Cap 600 there in early July. So in March, two of the three were net bullish. And so that's when we turned bullish on the market. And these bullish signals remained. You had one bearish signal there in February, but you can see we didn't get confirmation signals from large caps or mid caps with moves below minus 10%. So we stayed bullish on this indicator. But then in October, we got all three moving below minus 10%. Clearly a bearish signal. And you can see that new lows have expanded from October to December, and that is a negative. And to get this indicator group bullish again, I need to see two of the three move above this plus 10% threshold. All right, but until that happens, I have to remain bearish on stocks. And then just for good measure, I've got the NASDAQ 100 down there at the bottom, and it too triggered bearish in mid-October. The next indicator group is the percentage of stocks above the 200-day EMA, and I've got it for the same 4 indexes. So that's 3 indicators, 4 indexes, that's 12. My core group, though, would be 3 indicators for 3 indexes, S&P 500, S&P Mid-Cap 400, and S&P Small Cap 600. So I look for 2 of those 3 to give signals to turn net bullish on the indicator group, and when 3 of these indicator groups have turned bullish, or 2 of the 3 indicator groups have turned net bullish, then I can be bullish on stocks again. But I can't right now because all 3 indicator groups are bearish. Now, if we look at this indicator, we can see that we had bearish signals there, bullish signals there in March in large caps, mid caps, and then in April, small caps. And these signals remained until October. None of them broke below that 40% threshold. So a bullish signal is the move above 60%. And I don't use 50% because you get too many whipsaws. You get a lot of moves above and below that 50% line. So that's why I use 40%. I'm looking for enough critical mass on the downside to trigger a bearish signal. And we got that signal in mid-October when all 3 moved below 40%. And all 3 remain below 40%. In fact, all 3 remain below 21%. You can see small caps and mid caps are below 16%. So a lot of downtrends out there. Maybe we're getting to extremes, but being at an extreme is like a double-edged sword, because on one hand, it shows strength in the downtrend. On the other hand, it points to an extended oversold condition that could give way to a bounce, but that's about it. And then just for good measure, I've got the NASDAQ 100 there, and it triggered a bearish signal in October as well. Now, of course, to get these back on bullish signals, we would need to see 2 of the 3 move above 60%. So there's that 60% threshold, and we're quite a ways away from it. So I wouldn't expect that to happen anytime soon. Could be a few months. So despite this big decline that we've had, we have yet to see a volatility spike. So if you want to know anything about these volatility indexes, you can go to the CBOE website. Now here is the NASDAQ 100 Volatility Index, and you can see that even though we've had a lot of selling pressure recently, that this index here has not gotten much above 30% or 30. It's hit that 30 level a couple of times. But you can see prior bottoms, you needed to get above 40%. And even when you got above 40%, it didn't bottom right away sometimes. It took a little while. And there you can see the big move above 40% at the end of 2008. Now, one thing you got to also keep in mind is that volatility regimes can change. And if you look here in 2000, you can see volatility was above 40%, and we did get a bottom there, but volatility shot all the way up to 80, 90% in 2000, and then finally didn't calm down until 2003 there. Now, if we look at the VIX, which I think is the main one to key on here, and if you're looking for the stock market to bottom, I think you first need to see a spike above 40 in the VIX. You can see that level there. We had a spike above 40 in 1998, and that gave way to a bottom there. We had a spike above 40 in 2001. That was a temporary bottom because we moved to new lows after that. And then we had another spike above 40 and bottomed a couple months after that spike. And so you can see here in the 2008 bear market, we moved above 40, but it took a while to bottom. And you need to get back below 40. Volatility needs to settle, I think, for the market to move higher. And then you can see a couple spikes in 2010, 2011. But the bottom line is we have yet to make it above 40 and see some serious or true panic in the markets. And until we get that, I don't think we've hit a bottom. Now, if we look at the Russell 2000 Volatility Index, we can see the same thing. There's that 40 level. This one doesn't have as much history, as you can see. But, you need to get above 40 to get some sort of panic going, and then back below 40 to show that the panic has subsided. So you can see we got that there in the second quarter of 2010 and the second half of 2011. This is the European sovereign debt crisis, by the way. And you can see since 2012, we haven't even been above 35. So, to get a true panic going, we need to get above 40. So something happened this past week or two, and that's the defensive group started moving lower as well. So Richard Russell of Dow Theory Letters, rest in peace, used to say that in a bear market, the winner is the one that loses the least. And we don't have bear markets very often, and we don't know how long they will last or how far they will extend. But he's been through a few bear markets or went through a few bear markets, and that's pretty much the way it is. He who loses the least is the winner in a bear market, because eventually everything or most everything gets hit, and it's really hard to pick out the winners. Case in point here is healthcare. It was holding up and one of the leaders, but it got hit hard over the last 3 weeks and broke below its 40-week moving average and below support. And it wasn't just Johnson & Johnson, as I'll show here in a minute here. Here's consumer staples, supposed to be a defensive group. Well, this looks like a lower high, so it's underperforming in 2018. It's not even above that high. And then you got the breakdown there this past week with a sharp decline, the break below the 40-week moving average. So consumer staples are not safe. Then we look at utilities. All right, utilities are still holding up. And what I've got here is I've got XLU with dividends at the top. And you can see we've got a new high if you add in dividends. But if you don't add in dividends, we have yet to make a new high. And I think, people who bought remember the price they bought at. They don't remember the price with dividends added, so to speak. So, this is not really a breakout, because if you bought here and you're holding, you're back at your buy price when you get to 57. All right. It's not because you're at 56 now, you're at your above your buy price. All right. That's what dividends added in. Sure, you're collecting those dividends, but there's a difference between a collected dividend and your actual buy price. And I hope that's clear. And that's why I think you need to look at support and resistance levels using unadjusted data. But even though utilities got hit hard this past week, so they are not immune. You can see down 4%. So there isn't a lot of places to hide. Here are REITs with another illustration of the dividends. You see, you get higher highs with this dividend drift and the index because you're in the ETF because you're adding dividends as you go along. And so that creates an upward bias. And if you're not adding dividends, you can see we're still below this high from 2016 and we're at the high from late 2017. So if you bought, this is your buy price and you're coming back to the buy price and we're getting resistance at that buy price back in October. Whereas here it looks like we broke out, but in reality, we're back at that level without dividends. So you can see REITs have gone nowhere either. Hadn't been a great place to hide. So if we look at the equal weight healthcare or the equal weight consumer staples index, it's faring even worse with a lower high and a breakdown. And then we look at equal weight healthcare. This shows you it's not just Johnson & Johnson. All right, you had the sharp decline, a wedge, and a breakdown. So healthcare is not a place to be. Then we look at utilities equal weight down 4%. So you're going to be at risk no matter which stocks you own. Here's how utilities handled the last correction. They were already down heading into the correction in January, February, March, and they stayed pretty much unchanged. And then we look at equal weight REITs getting hit as well. And then two more, healthcare providers slammed, a big bearish engulfing and a breakdown below that 40-week moving average. And medical devices, kind of a little channel and broke out of that channel. So there aren't a lot of places to hide in a bear market. Treasury bonds made a big move yesterday and are making a bid for a big reversal. All right, so I'm not going to talk about the Fed. I'm not going to, give my opinion about how Powell is acting and what the Fed has done because I really don't care. Pretty much, I think the Fed gets, too much blame when things go wrong and too much credit when things go right. And you're better off just looking at the price charts. And if you want to look at something, look at the Fed balance sheet chart, which I've showed before, and look at the spread between high yield bonds and Treasury yields. But if you look at the TLT here, I've got a 6-month chart of unadjusted data. This doesn't include the distributions. It's pure price. And you have this big move up and then a big move down. But if you look at it, it looked like we broke support here, but this support break did not hold. So you came down, stalled, and broke right up. And now we've broken above the 40-week moving average and above this wedge line. So the boundary of that wedge has been broken. And if we get a further breakout there at 123, that's going to call for higher Treasury bond prices. And what does that mean? Well, if Treasury bond prices move higher, that means Treasury yields are moving lower. Now here's the IEF, the unadjusted IEF, the 7 to 10 year Treasury bond ETF. And, it looks a little bit different, because it came all the way back down to these lows here pretty much with the recent decline. But it is also making a bid to break out above this trend line. I don't put too much credence in trend lines. I'll use lines to mark boundaries of patterns, but that's about it. And then you have this resistance zone here that we're trying to get a breakout and move higher. Then if you look at the 10-year yield and the 30-year yield, you can see that they have been moving higher here since this breakout in the summer and fall. But we had a little triangle breakout that failed, and now we're on the verge of breaking support. And you look at TLT, there's that wedge, and it is on the verge of, TLT, the 30-year Treasury yield is on the verge of breaking support here. And if it does, that would call for lower Treasury yields. Now, since we're on Treasuries, we'll just check in on the yield curve because we do have some inversion working. You can see that the 2-year yield is above the 5-year yield. Over on the left, you can see the actual prices. It's not by much. 2 years at 2.63%, 5 years just below it at 2.62%. Now, when we look at the 10-2, which is the one that most people use for the yield curve, the 10-year less the 2-year, you can see the yield curve has been flattening for years, but it is not inverted. So you can see that the 10-year is still above the 2-year, and I think the real fireworks don't start until you see that 2-year yield move above the 10-year yield. Now, as far as the global situation is concerned with Treasury yields, they're moving down. All right, you can see that the U.S. Treasury yield has been moving down for about 2 months. The U.K. yield has been moving down for about 3 months, or 2.5. The U.S. 1.5, excuse me. You can see the German 10-year yield has been moving down for 2.5 months recently, but it's also been moving down for most of the year. And we can see the Japanese 10-year is barely positive. So rates since this October decline have mostly been moving lower, and that tells you that money is moving into safe havens, and that reflects a dimmer outlook for the global economy. So at some point, the market is going to bottom, but until then, we need to monitor the trends and monitor benchmark levels, and I'll show you what I mean. So if and when the market does bottom, and there's probably going to be a period of consolidation, a period of volatility, maybe even a little bit of low volatility at the end. But the point is, after this kind of a breakdown, we need some time to settle. We need some time to heal. So I don't expect a bottom in the next 2 weeks. It's probably going to be a few months. But what I watch for is benchmark levels. And what do I mean by that? Well, if you look here in this March-April period, after the market was hit hard there in February, you had a March low. And the S&P 500 moved below that March low in early April there. And you can see that the mid-cap 400 barely moved below that low. And you can see that the small-cap index held that low. So basically it had an equal low there, and it held the 200-day moving average. It held above it. So it was showing less weakness during this March decline. All right, and that's what you want to be interested in. And then you look for a little breakout there, and there was some leadership there in small caps into July. So I'm looking for stuff that is holding up a little bit better, if you will, to lead if we get a bottom. And if you look at the NASDAQ 100 there, you can see when the other indexes here were making lower highs there from late January to March, the NASDAQ 100 had a higher high. So it was showing relative strength there in March, even though it did dip below that low there. But it did have a pretty good run into July. Now this chart here shows the equal weight S&P 500 at the top, which is serving as our benchmark to watch price action and compare. And I've got the First Trust Internet ETF, I've got the software ETF, and I've got the cloud computing ETF. And what you notice here is in September and October 2016, the equal weight S&P 500 moved down. But look at SKY at the bottom. During this period, it moved up. And that was showing relative strength during a correction. The broad market was correcting, but the SKY, the cloud computing ETF, was not. And if you look here in March, we saw a correction in the equal weight S&P 500. But if you look at the First Trust Internet ETF, it was actually working its way higher. And so was the software ETF. It wasn't correcting with the rest of the market. And they had really good moves from April, May, June, and July of 2017. And this is just to give you an idea of something to look for in the coming months. If you see the market is firming, or you look for stuff that is holding up well if the market continues to go lower, and then if the market looks like it's bottoming, they may be the leaders going forward. All right, now I'm going to look at some pockets of strength in the international and commodity markets. All right, so this is about as close as I'm going to get to a 2019 forecast, because I am kind of a zen in the moment kind of trend following guy. I basically look at the trend. If the trend is down, I'm out. If the trend is up, I'm in, or I'm looking for entry opportunities. And right now, the U.S. stock market, we're in a downtrend clearly. We're in a bear market. And so I'm not even looking for opportunities in the U.S. stock market. Now, it's hard to imagine other stock markets bucking the trend, but sometimes it happens. And I'm also looking elsewhere, like some of the commodity areas. And I noticed cocoa is showing a little bit of, well, you can't say relative strength relative to the stock market, because there's no relationship between cocoa and the stock market. I know I'm doing my part to support the cocoa business because I eat lots of dark chocolate and I love it. But what I see here is a potential higher low forming from December to October, December. And then you can see this kind of a wedge, which I deem a corrective pattern. And if we get a breakout there in that 2400 area, that is going to be a bullish development for cocoa. And there is an ETF. It doesn't track as well as the continuous futures does, but it's something to consider if it gets a breakout there at 28. And I'm not going to comment on the liquidity of these ETFs. They're not that liquid, and there are not that many opportunities unless you can go into the commodity pits. Another one is copper. Now, this one is still bearish, and the base case is still bearish because what you have here is you had a breakdown with this decline, and now we've got a consolidation after the decline. This is the continuous futures. And a consolidation in a downtrend is typically a bearish continuation pattern. And if you break below that consolidation boundary, that signals a continuation lower. But what I'm noticing about copper is it's holding up. All right, it didn't move below these summer lows. It's above these summer lows. And so that leads me to believe a little relative strength that needs to be watched for a breakout. And if we get a breakout there in copper, that would be a bullish development, but it hasn't happened yet. Now, before we get to palladium, note that palladium was first covered in On Trend on June 5th. So that was almost 5 months ago or so, when it was first breaking out of this wedge. And if we look at palladium today, there it is hitting new highs. This is a continuous futures contract, and the ETF is hitting new highs. Now, it may seem overbought, overextended, but clearly the trend is up, and this is definitely still a leader out there. Now we'll turn to some international ETFs that are holding up. In the top window, I've got the India Nifty 50 ETF, and you can see that it declined most of 2018 here. It was weak. But if we look at the actual index, the Nifty 50 index priced in rupees, we can see that it held up relatively well and consolidated, and it just edged above the 40-week moving average. And the reason the ETF here is underperforming is because the rupee fell quite hard from January until early October. But the rupee has started to firm. And so if the Nifty 50 holds its breakout there and moves higher, and the rupee stays firm, then the Nifty 50 ETF could continue higher as well. So that's one to watch. Next, we have Indonesia, and the Indonesia ETF is holding up quite well. You can see it broke above the 40-week moving average there and is consolidating above that moving average. Even if it falls back to that 23-24 area, that might be an opportunity. So watch for what is holding up when the rest of the world is moving down, and this is one of them. We look at the Philippine iShares. You can see that it had a big surge and then a consolidation, a little bit of a triangle forming there. And so if it can get a break above that triangle line at 32.5, that would be bullish. And finally, the Brazilian iShares is holding up quite well. First of all, you see the Bovespa, it's moved above its 200-day and is holding above it. It hit a 52-week high in November, early December. The ETF got hit pretty hard at the beginning of the year there, and that was because you can see the Brazilian real was hit pretty hard. So now that the real is firmed, we've got a little flag forming in the ETF at the top there, and if we get a flag breakout, that would be bullish. So that concludes the last on trend of the year. On behalf of Stock Charts, I'd like to wish everybody a very Merry Christmas, a Happy New Year, and a wonderful holiday season. I'll talk to you again in 2019.